I think investors do understand that the increase in the amount of carbon in the atmosphere creates a risk for the real economy. And it creates a risk for investors, not only in terms of the valuation of the assets that will be impacted by the risk of climate itself, the direct impacts in terms of storms and temperature and rising sea levels and so on, but also in terms of the valuations of the assets they own today, which are exposed to policy initiatives, in particular, appropriate pricing of emissions. Right now, the basic problem with respect to climate risk is caused by the fact that we're not incorporating the externality, the potential damages created by emissions. Investors have been slow to recognize the implications of this being a risk management problem. The implication being that the pricing of emissions should be instituted immediately at much higher levels than people recognize. The U.S. government estimates that the appropriate price for emissions is about $40 a ton. But actually, many scientists think that this is, in some sense, a lower bound, that the economic models, which were relied on by the U.S. government, don't adequately capture the potential for catastrophic risk. And that potential means that we need to price emissions cautiously. We have to use a precautionary principle. And if we're not sure that, let's say, $40 a ton is the right price, and we're not, there may be boundaries that get crossed, causing irreversible changes that could have untold impacts. And we have to think about the worst case scenario. That's one of the messages of risk management. It's not just the expected impacts. It's actually pricing the worst case. And so those prices could be much higher. And those will affect, that pricing when it happens, will affect the valuations of the securities in their portfolio. So the concept that I like is called stranded assets, and it refers to which assets will be negatively impacted by appropriate pricing of emissions. The most obvious is coal, because when you think about not being able to burn enough fossil fuels, or as much as are on the balance sheets of corporations, the implication is that those coal companies in particular, as well as other expensive sources of fossil fuels, things like oil from tar sands, oil from deep sea drilling, from the Arctic, those are assets whose valuations are artificially inflated now because we're not appropriately pricing emissions. And when we create those appropriate incentives to reduce emissions, those valuations of those stranded assets will fall. So investors face that risk immediately. It's not a matter of waiting 30 or 40 or 50 years and seeing what happens. It's a matter of those expectations of appropriate pricing of emissions could cause those stranded asset values to fall very rapidly. And in fact, I think they're already falling. The World Wildlife Fund, where I'm the head of the investment committee, put in place a little over a year ago a swap where we have sold our stranded assets and receive the return on the market. And the stranded assets in the last 12 months have fallen dramatically in value, even after having fallen each of the previous 3 years in value relative to the market. And so that's something that's going on right now. That positive return from the stranded asset swap reflects the changing expectations of investors about emissions pricing going forward. I think investors are really key, because investors own collectively the economy through the corporations that they invest in. And so they can engage with those corporations to say, look, this is a real problem that needs to be addressed. It has implications for the entire economy. You all should be prepared for that. Build in appropriate expectations of emissions pricing. And engagement on a number of different dimensions with respect to oil companies. What's going to be your plan for the future when emissions are priced? Are you making investments today that are not going to pay off because of that? I am particularly focused on the aviation sector, because aviation needs the ability to create emissions. It doesn't have any alternative technology now or likely into the future that's cost effective for reducing emissions. So aviation is a growing sector of the economy that's going to need the capacity to create emissions for 30, 40, 50 years into the future. Right now, that capacity, which is a scarce resource for aviation, is being wasted by the rest of society and the rest of the global economy. So if we price emissions appropriately today, over the next 10, 20 years, we will create an infrastructure that dramatically reduces the amount of emissions coming from ground-based activities. But what is aviation going to do? So the sooner that we create those appropriate incentives, the better in terms of aviation. And I think investors who have a long-term horizon should be engaging with aviation. And the reason I focus on aviation is because they are a global sector. They have already agreed to price emissions in the context of a market-based measure that would be the first globally harmonized price on emissions. What we really need to ask of aviation is that that price be set appropriately, that a governance structure be created such that the price that comes out of this market-based measure accurately reflects the economic externality.
What do you think, just staying with the example of the aviation sector, obviously it cannot move away entirely from greenhouse gas emissions. The greenhouse gas emissions are innate to the aviation sector, but surely they can improve their carbon performance over time. They can become more efficient over time with new technologies, and they can become more carbon efficient. Do you think investors have a role to play as owners of aviation companies?
Absolutely.
In driving those efficiency gains over time, and how can they do so?
Yeah, and aviation has the incentive to lead in this effort, and investors have the incentive to give aviation the motivation to take the lead. Because
how can they do that?
How can they do that? Engagement, indeed, engagement. By talking to the aviation sector about the market-based measure that they are creating. And the real question is, how is that price going to be determined? And the aviation sector hasn't really addressed that. They think that it'll be a very low price because they hope to buy cheap offsets and credits. And really, it's when you get into the details, where are those offsets and credits going to come from? Who's going to certify those? There should be a governance structure that says we don't want to create a glut of cheap offsets and credits. Rather, we want to create a system, either a trading system or some other system for creating appropriate incentives to reduce emissions in aviation, but also as a signal to the rest of the global economy. What's really missing today is an intentionality about pricing. It's not just to create a price, it's to create an appropriate price. And so what that means is we need experts, we need science, and we need economics to help decide what is that economic externality. And to the extent that there's uncertainty, which there certainly is, about what the appropriate price is, that means the price has to be higher. We have to have a price that gives us high confidence that we're going to solve this problem. So if we don't know that $40 a ton will solve it, maybe we need to go to $60 a ton or $80 a ton. And it's not a fixed price for the next 20 years. It's a price that reflects our best information at each point in time. So it's really a process and a governance structure that leads to an appropriate price. And we don't have that. We don't have that in the EU ETS. We don't have that in California or RGGI or any of the other venues around the globe that are creating prices. Those prices are all too low, and they're all being set by basically some sort of system that hasn't taken into account what is the economic externality. We really need a directed system that tries to reflect that externality, and aviation is perfect because it would be a globally harmonized benchmark. So I think investors have absolutely an important role to say to aviation, we need you to take the lead, we need you to set up a governance structure that creates a global benchmark price that appropriately reflects the economic externality. Sadly, we have a very weak global governance structure in the United Nations, and the process that's been going on for decades in the United Nations of governments trying to set targets and worrying about the quantity of emissions and how much they're going to reduce the quantity is just set up in such a way that no one has the incentive to come to an agreement. Every person sitting around the table, every country I should say, sitting around the table has an incentive to hope that everyone else does a lot to reduce emissions because they'll benefit from that, but to do as little as possible themselves because it costs them and their economy. And then you've got the split between rich nations and poor nations are saying, you caused the problem, why should I have to pay for it? And by the way, I can't afford these damages that are already happening. So this leads to a very bad dynamic, and I can't imagine that we're going to get any sort of incentive to reduce emissions coming out of this process in the United Nations. On the other hand, investors have every incentive to respond appropriately immediately in terms of their engagement with corporations, in terms of setting up an appropriate emissions pricing system. And perhaps the UN can help work with investors to engage with the global economy and get that done outside of the highly politicized and sadly ineffective governance structure that's in the UN itself.